So, of course, we always talk about stocks. I just want to kind of give you guys a stock right now that is super, super, super undervalued. And for our clients, this is one of our biggest holdings, and we are buying this today because of the drop. So the stock is Palantir. Anybody has heard about Palantir? Now, of course, my clients, of course, you guys know. So Palantir is basically a tech company and a military defense company in one. So think about Lockheed Martin and Boeing, and then Microsoft all in one, right? So they were a big reason why we started the strikes with Iran in February. That at first, now besides of course us bombing the school with 162 children, which was horrible, but they were like a big reason why that we had a lot of precision strikes without having boots on the ground, is because they do AI trend analysis to see where a person's going to be or where a target's going to be. So it's easier for the military to identify the target and then kind of do what they do from a drone strike standpoint. The days of boots on the ground, I think, is over with. It's all about cybersecurity and drone fighting now. I think that'll continue. But Palantir last year, they got the largest military contract ever awarded by the Pentagon. And this year, they are right now trying to get now the largest. So like they're going to get an even larger one compared to last year. And then also one thing that helps them out is that the Pentagon about a month ago that was giving money to a company called Anthropic, who actually owns Claude. So if anybody here uses Claude, and I'm a big fan of Claude. I like ChatGPT, but I think Claude is better. But the company over Claude, Anthropic, who helped the Pentagon, they basically, for right now, is not with the Pentagon because they said that they didn't like how the Pentagon does drone strikes without a actually human making a final decision. So, but just as anything, like stuff happens from a stock standpoint. And their stock has just been getting battered. It's down by 7% this week. Over the past month, it's down by 15%. Over the past 6 months, it's up. It's up, right? But again, it's just going down. So, we always like to kind of talk about the strategy. I always talk about, right, the cliff dip bear strategy. If a stock that you love is down by, 5%, we want to put a small amount in that stock because it's trending down. So that's kind of like the cliff. And then the dip. If something dips, that's when it goes down by 10%. So when it goes down by 10%, we're going to put a little bit more into it. Well, right now, Palantir is actually almost down by 20% from its high. And that's the bear territory. Because from an investment standpoint, you have a bear market. And when you have a bear market, it's down by 20%. And Palantir, if it has another bad day today or tomorrow, it's going to get there. So just for a stock that you might want to look at that we believe is going to go back up eventually, we think it's going to get back to where it was. Once that happens, then so look at that. It's down by 30% this year, you guys. Just crazy, right? It was as high as $207 a share. Now today is at $116. I mean, so you're literally buying it at a supreme deep discount, and we think it's going to go up eventually. Now, when will eventually happen? We don't know, but definitely it's a stock that we think is going to go up dramatically. So it might be something that you want to put a small amount of your money into and kind of sees what happens. Yeah. All right, so that is that. So now we have Sydney West. Before we introduce her, this is like great timing, right? This is great timing because today, I don't know if you guys saw this as I continue to share my screen, but President Trump came out today and he basically paused a bill that he was going to pass. Right now, we all probably heard stories, and it's great that we have Sydney here that's going to explain kind of how to buy a house with no money out your pocket, because that's what she does. But it was an act that was going to be passed today. And that act was called the 21st Century Road to Housing Act, right? And it was going to basically help ban institutional buyers. So like large hedge funds, a lot of mutual funds now are getting into the housing space, right? So it's going to ban a lot of them from basically taking up the houses, right? So who here is in housing and was in a situation where they got outbid by somebody? It's happening more and more, you guys, because from an investment standpoint, right now, these mutual fund companies, these hedge funds, they're looking at housing as like a dividend paying stock, right? Because a house is kind of like a dividend paying stock, right? You buy a house over time. The thought process is that the house is going to appreciate in value. Now, historically, a house does not go up as much as a stock does historically. Now, past performance doesn't guarantee future results, but typically over time, a house will go up in value. But then also we're getting cash flow, and that's our rental income, right? And typically from a housing standpoint, houses pay you more cash flow than a dividend will. On average, the average dividend is going to pay you, 5-6% a year. You should be getting cash flow of 10 to 15%. So it's like a dividend paying stock. right? So now these large institutions, these hedge funds, these mutual funds are basically overpaying for something. So let's say a house should have been 150,000, they might pay 180,000. They have cash, and we all know cash is king. So for those reasons, a lot of individuals, the mom and pops, people that just kind of want to get a second or third property to kind of build their real estate portfolio, they're being priced out. So this act was supposed to help individuals and basically stop the hedge funds from doing that. But that act is not going to be passed today. It also boosts home supply. It's going to do about 45 provisions aimed to streamline federal regulations, easing zoning requirements. So anybody that's going to do a new build, we know how bad zoning is, and also expanding funding to accelerate new affordable home construction. We all need funding, especially as mom and pops individuals. But that's why Sydney's here to tell you guys, what she does and how you can tap into her, because what she does is pretty cool, as she's able to get most of her profits with no money out of her pocket at all. Then it also is exemption for builders. So right now, when you build a house, you build it, but then to kind of get money, right, you end up selling it, right? But now they're going to have some exemptions in place where instead of building a new property and then selling it, you can actually build it and then rent it out. So then you can keep some of those tax deductions that we always talk about, right? The cost segregation. If we sell something, then we have to recapture that tax deduction that we got. Well, now if we're renting it out, then we get to keep that tax deduction, which means we don't pay as much in taxes. And all the other things we do from a depreciation standpoint, we don't have to recapture that because of us being able to now rent out that property instead of selling. So tonight I'm going to talk about this bill with more detail and kind of what we can do as investors to take advantage of it. But yeah, like this literally just came out about an hour ago. And the president's doing this because he wants to basically have voter registration. So I'm not trying to be political, but voter registration is a huge hotbed issue with one side of the aisle, and with his side of the aisle, he wants that to be buttoned up. And he said that he's not going to have any legislation passed until voter registration gets done. And he's basically kind of stopping this, which I don't agree with. I don't think one has to do with another, but that's why I'm not a politician. So yeah, so my mods, you can definitely put that into the chat, the link for tonight as well. But enough about me. Tonight, or it's not tonight, but today is all about Sydney. We have Miss Sydney West. Now she's she's military like me, so hoorah, she's Army, right? So go Army, beat Navy, go Army, beat Navy. But yeah, she's a real estate investor with 80 plus rentals, you guys, and she bought 80 rentals in 3 years. Think about that. And she did this by being an attorney, so she had a full-time job as an attorney, and she bought 80 properties in less than 3 years as she was a lawyer. She was tired of a 9-to-5 grind, and she learned how to leverage asset-based financing to buy multiple properties with no money down. I repeat, she bought many, many properties with no money down. So as we talk about all the time, you can buy property with no money down. She is a walking example with 80 properties to show forth. Now she's a full-time investor. She's in Charlotte, North Carolina, and she's focused on buying apartment buildings and building homes using this same strategy. So Sydney, how are we doing today?
Hey, Mar, I'm doing great. Thank you for having me. Really, really appreciate it. And really excited just to give your community a ton of gems. And hopefully they leave here with not only insight, but real steps on how to go out and do it themselves.
So whenever you want to get started, the floor is all yours, Sydney.
Very good stuff. Good stuff. Seems like most of y'all own properties, but it actually seems like it's split. So I'm gonna just keep that in mind as we kind of go through the presentation. So what I'm gonna be talking about today is how you can go out and buy multiple properties over the next, call it 12 months, despite how much money you might have in your account, despite your credit, and despite your income. So let's say that you're self-employed. Right. I've been self-employed now for 2 years. So as you can imagine, I don't report much on my taxes, but it's not a hindrance to actually being able to buy real estate. So we don't have to go the traditional route of worrying about, what have we made over the last few years or what our pay stubs look like. We can still qualify for bank financing. And that's what I'm going to be teaching you guys today on how you can actually do that. So before we get started, quick intro. I think Mario did a phenomenal job as it is, but I'll kind of recap a little bit about what he said. So as you mentioned, I live here in Charlotte, North Carolina. I got into real estate in top of 2023 in January. I had been a lawyer in Washington, D.C. for about 3 months and quickly realized I hated the 9-to-5. Took me about, 7 years of going to school and then 3 years of actually working that job to figure that out. But we figured it out and I was like, I kind of want to get out of this. And I want to make sure that whatever I do after this point in my life, I'm able to actually have wealth and I want to be rich, right? So I want to make money right now, but I also want to make sure that the money that I generate is not going to be tied to my time. And that is what makes you wealthy, right? Wealthy is when you have assets that pay you every single month or every single year, despite your time investment in that thing. And so I wanted both of those. And so immediately I lean into the only thing I know, which is what? Real estate. And not because I had experience, but simply because I was a renter my whole life. So I understood that you buy, you rent, and the person who rents to you generally is the one who makes the money off of you. And I was like, all right, let me get into that. I learned the strategy that I'm going to talk to you guys today. And over the course of my first year, I ended up buying 8 houses. My second year, I bought about 17. And last year, I bought about 45 rentals. Today, I own a little bit over 80 here in the North Carolina market. I got out of my 9 to 5 job as a lawyer. I retired my mom as well. And so I'm super passionate about this strategy because I don't think a lot of people talk about it. But more importantly, I love the impact it could have. Like being able to at least retire my mom for me was something that was powerful. It was always my goal to do it before I was 30 years old. And I know I'm sure there's a lot of people in this room that were often striving for generational wealth. And if you're anything like me, I was not in a position to only worry about the generation that comes from me, right? So oftentimes as children of immigrants, we got to worry about the generation above us as well. And so I think it's really important for us to understand that we can still take care of both generations and we can utilize this strategy to do so. And so that's a little bit about me. So you can see I'm qualified to even speak on this. So first things first, before we jump into the material, I just want to lay the foundation so that everything I'm about to tell you actually sinks in because it's actually going to contradict everything you've ever heard, right? I'm sure Mario's probably talked about this in the past of you probably don't need 20% down to buy a house. The reality is there are lenders out there that's going to fund anywhere from 90 to 100% of the purchase price of a property, and they're going to give you 100% of the money to actually renovate the property itself. Now, it's going to depend on the lender, and we'll break that down further here in a few. But just know that at the most, you would need 10% down, and oftentimes you're not going to need any money down at all. The second thing that I'm sure you've heard is you need at least probably above a 640 credit score, right? The reality is, though, is that there are lenders that they do not care about your credit score at all. Meaning they're not even going to do a credit pull to see what your credit score is. They're going to evaluate the property itself, and then the approval of the loan is going to be subject to the property, not subject to what your credit score is. And lastly, it's the income piece. I'm sure you've heard you need 2 years of tax returns, you need pay stubs, you got to worry about your debt to income ratio. Again, these lenders are not going to actually care about how much income you make. They more so care about the property itself and whether it's going to be a profitable investment, right? So, with that being said, let's go through the 5 step framework to how you can buy multiple rentals and actually build and scale a portfolio that ultimately generates enough cash flow for you to have freedom or wealth. So, the first thing is you got to buy the property. And this is where most would get stuck at because they say, well, I don't have 20% down and I don't even know how to go about looking for these lenders. And so you want to go ahead and buy leveraging an asset-based lender. Asset-based lenders, number one, they're not going to personally qualify for these loans, meaning your income doesn't matter, your credit score doesn't matter. They qualify the loan based off they approve the loan based off the property itself. Okay. So what's going to matter is whether your property meets what's called the 70% rule. And I'm going to break that down here in a few. If the property passes the 70% rule, they will go ahead and give you the funding for it. And so not only do you not have to personally qualify, but even better, they're going to give you more leverage than the average bank ever will. Now, I'm sure you guys know you can probably go into Bank of America and get a loan for your investment property. You can absolutely do that. However, it's going to be based off your income, it's going to be based off your credit, and I can guarantee you they're not going to give you 100% of the purchase and they're not going to give you 100% of the money to renovate the property itself. And so with these lenders, they're going to give you the max amount of leverage. Now, how do you actually get approved for these loans? Like I was saying, the property needs to be what's called the 70% rule. Now, the 70% rule says the following. It basically says your all-in cost for a property, meaning the price of the property and how much you would spend renovating on the property. It can't be more than 70% of the property's after repair value. Meaning it can't be more than 70% of what that property would be worth after it's renovated. So let me just give you as a quick example. Let's say that you find a property that you've identified and you're like, I think this could be a good one and I want to get 100% financing for it. Well, if the property would be worth $100,000 after it's renovated, your all-in cost for the property cannot be more than $70,000 because $70,000 was right. And so if you know, okay, I can't go over $70,000, you might say, well, let me offer the seller 50 grand and I'll spend $20,000 renovating it. And that way the lender's going to approve the loan. Or you might say, I'm going to go ahead and buy the property for 60 grand and I'll spend $10,000 renovating it and the lender will approve the loan. No matter how you slice it up, as long as you meet the 70% rule, they will go ahead and approve it. So essentially, what these lenders really care about, guys, because they're giving you leverage and they're putting money out for these properties, and the loan is secured by the property itself, right? That's the collateral. They want to make sure you're buying a good deal. In regular terms, they want to make sure you're buying a property that you're going to have equity in it so that in the event, probably, hopefully it's not going to happen, but in the event they had to foreclose on you, they actually had a decent property. That's always their goal, right? Not to foreclose, but to make sure that they are protected and that their investment is protected, which ultimately, though, forces you to actually find a good property. And so if you learn how to find properties that fit within this guideline, you open up the floodgates of how much you can buy. And that's why I ended up buying so many properties over the course of a year, because I quickly realized that if I had money to buy real estate and I learned how to find properties off market that met this rule, these lenders don't put a cap on how much you can borrow. So you can borrow up to usually $2-3 million of loans. You can buy in all 50 states, and you're not even limited to just houses. So you can buy a duplex, you can buy a 4-unit building, you can buy apartment complexes. So like Mark had said earlier, I went from buying houses my first year, and then I got into duplexes and triplexes. And then last year I did was buy apartment buildings. So I'm purely commercial now. And I use the same lenders and the same strategy. And so to give you guys a couple of gems there, if you guys are going to be interested in, knowing who these lenders are and reaching out to them, a few of them, just so you guys know, and actually let me drop them in the chat so that you guys have them, okay? So one of them is going to be Turnus. They're based out of Charlotte, North Carolina. They'll do 100% financing on the purchase and 100% on the renovations. Even if you are a first-time investor, even if you've never bought real estate, you don't own, you're the one that dropped a zero, you can still get 100% financing with them regardless of your credit score, okay? They don't do a credit check whatsoever. Now, another one.
Sydney,
What's up?
this is great information. So do they do a soft pool or they don't even do no soft pool?
No soft pool.
That's crazy. So you can have jacked up credit, just jacked up from the flow up, and then they would still say yes because of the asset.
Exactly. So we have students that they have 580 credit scores, right? They got 480 credit scores. And we go with Turnus most times because they're not going to do a credit pull whatsoever. It's going to be purely based off the numbers. And are you buying at that, at a price point that makes a 70% rule? So again, guys, that is the only guideline they have. That's the only guideline. Then you don't have to show your income. You're not going to show, again, your credit score. You're going to focus solely on finding a property that meets that criteria. Carl, it's Turnus. So I dropped it in the chat too. It's Ternus. And then I dropped another one in there, which is called Longhorn, guys. Longhorn, they do want you usually to have above a 600 credit score. And they will lend, I would say they're not in all 50 states. They're probably in like 15. They're big in the Southeast. I can tell you that. Northeast as well. So at least those two you can definitely check out and compare your options if you want to get to a point where you start looking for properties. And now you at least have the lenders that most people don't have. Because I always tell people you can get a lot of gems online, but the lenders that are actually offering 100% financing, investors always keep those close to their chest, right? Because they know that if everybody has access to lenders that are giving 100% financing, we all know what's going to happen. Because currently only one of Americans own more than 3 rentals. So I'm going to assume that if more people knew about this strategy, that will probably increase from 1%, maybe 3 or 4, right? Just a little bit more. Because access to capital is going to change everything. So that is how you buy with these lenders. Now I'm going to explain to you how you renovate with them. So let's say you bought the property, you closed on it. Cool, they gave you the money to buy it. Awesome. Now it's time to renovate the property because they want you to increase the property's value. If you bought the property, let's just say for $50,000 and you're like, hey, can I also get $20,000 to renovate the property? And it's going to be worth $100,000 after it's renovated. Well, guess what? Now it's time to do the work. So you're going to go ahead and you're going to renovate it with the lender's money. The way these work is that you complete a portion of your renovation and you get reimbursed. So let's say that 1 week you go ahead, you do the floors. Okay, cool. Now you're going to get reimbursed because you've shown proof to the lender that, hey, I actually did the floors. And so that's what's called draws in this space. But ultimately, they'll make you whole by the time the project ends. And I always tell people, number two things: focus on properties where there's minor repairs, minor cosmetic repairs, like this photo right here. The kitchen, it's beat up, but all it's going to require is new kitchen cabinets and new countertops. This isn't a massive project. I see a lot of beginners, unfortunately, they go for these fully gut, fire damaged buildings that it's going to take 6 months, 12 months to renovate. The longer a project is going to take to renovate, the more time and more money you are going to spend. Because time is money in this business, anyways.
Hey,
And so
City,
you
can
want, go ahead.
I ask another question?
Yeah.
All right, so I'm selfish because I'm going to Puerto Rico for 2 weeks, so we're actually looking for property. So,
Yeah.
so Terrace and Longhorn, it's even in Puerto Rico as well, or is it just in like, even though Puerto Rico's America, but it's like, like America, America.
America, America. I don't know if they'll land in Puerto Rico. That's a really great question. Because yeah, I don't, they are a state, or are they a state?
Then the
Get
territory.
back with us on that.
What's up?
Somebody said somebody get back
I,
with
s-
us. Yeah. Okay. Well, no.
I said that was a good response. We'll get back with you on that.
Okay. Cool. Thank you. Thank you.
Yeah, because the lender that I just showed you guys on the previous slide, right? They specifically say in all 50 states. So normally that's what I see when I see from these lenders. I don't think I've ever seen like all 50 states and Puerto Rico.
Okay.
That's been my impression of it. So I wouldn't know exactly for Puerto Rico, but definitely the states for sure. And then I saw somebody ask in the chat, does this work for commercial properties? So it works for commercial residential properties. For example, multifamily properties. This works for like, that's why I tell you guys, I'm mostly in the commercial residential side of things now with apartment buildings. Now, do these lenders lend if you're doing offices and storage units? Not these lenders. There's other lenders for those, but not these lenders. They're mostly for residential properties because again, they're looking at whether you can improve the property's value. And then I'm going to show you guys on the back end, they care about how much income that property is going to generate over time. Those are like their key metrics. Okay. Whereas like 40-unit building. Absolutely. So again, guys, you then use the bank's money to go ahead and renovate the property itself. When you're renovating it, we want to be fast with it. Okay. And a quick tool right here for you guys is that if you end up deciding that you're going to renovate a property and you do not live in that state, right? And so now everybody's concern is always, well, how am I going to renovate a property if I don't live there? I don't know anybody. And everybody has a bad contractor story where they've been robbed and contractor never showed up. You want to keep two things in mind. Number one, you always need to pay contractors in milestones, meaning you will never pay a contractor upfront. You pay them as work is being completed. So for example, let's say this kitchen. This kitchen is part of an entire house. And let's say for the entire house, you're charging 30 grand, but for the kitchen is 5 grand. Okay. Well, why don't you start with the kitchen? Once the kitchen is renovated, I'll go ahead and I'll send you the $5,000. Very simple. And so what happens now? Now they got $5,000. They had to work a full week to do that. Now they got the $5,000, but now they want to collect the other $25,000. And so in order to do that, now they're incentivized to go back to work and keep going every single week because they want to collect that money as fast as possible. So that is how you manage those contractors and get them to do the work fairly quickly. On top of that, again, if you don't live in the same state and you're wondering, well, how would I do that? Cindy, how would I know what they renovated? Use an app like Company Cam. Company Cam is an app that you can have your contractor download. I've done this several times. You put on the app what you want them to complete. And as work is being completed, they have to geotag their location. So their phone has to physically be at your house. You can't go and download photos off Google. You can't send me screenshots. Nope. You got to be at the property. Allow the phone to specifically state your location, and then they have to take photos, and that's how you would get proof that things are being renovated at the property without you physically going and checking on it. So those are some quick tips on how you're going to go ahead and renovate these projects because they are going to take, let's just say, 2 months. Normally, I tell people 2 months, max 3 months is the most ideal time frame for these projects. Now, once you've gone ahead. Let's say you renovated, the bank gave you the money, you're happy about it. Now you get to the part that you really want to be at, which is renting the property out, right? So because they gave you the money to buy and to renovate it, your property should now be in an ideal position to make the most amount of cash flow possible. Why? Most people, when they buy a rental, they put 20% down. They rarely have enough money left to renovate the property. And that's usually the difference between a property that's going to rent for $1,000 a month and let's say another one that rents for $1,500 a month. And so because you've renovated a property, you're going to have a higher quality of tenants coming through the door. And people always ask me the following: should I do Section 8 or should I go to regular rentals? I'll tell you, for me personally, I do regular rentals. I do not do the Section 8. Mostly because here in my market in North Carolina, Section 8, they pay about $300 less per month. So if my apartment's rent for, let's say, $1,000 a month, the housing authority is going to pay me $700 a month. So it doesn't really make sense from a cash flow standpoint for me to take $300 less per apartment when I still have to do the same amount of work. It's the same apartment. However, there are markets like your Ohio's, your Detroit's, where, the regular market might say, we rent for $1,000, and then Section 8 will come through and say, well, we'll pay you $1,400. I recommend always just checking what the housing authority is paying. So you go on like HUDhousing.gov, HUDhousing.gov, you go ahead, you look at your property zip code, your bedroom count, and it'll literally tell you right there how much they're paying. So compare both in order to make sure that you're getting the most amount of rent out of your property. Now, the beautiful thing about owning rentals, and I always tell people this is exactly why the wealthy buy and hold, because you're going to get paid every single month in cash flow, right? The difference between your mortgage and the rent, that is cash flow. On top of that, your tenant's going to be paying your mortgage every single month, because every time they pay you rent, you're going to turn around and pay the bank. So what happens over time? Value of the property increases, loan balance decreases, equity increases, profit increases. So over the course of 10, 20, 30 years, let's say actually 20 years, what's happened? Your tenant paid down 65 plus 65, 70% of your loan. You didn't pay your loan down. It's not like your personal home where you're the one actually paying your mortgage balance down. And then 20 years from now, if you want to sell, you can sell it. Or you can go ahead and then refinance, pull that cash out, and go do something else. But it's capital that you have access to thanks to your tenants. So you get monthly cash flow, you get equity over time, and then on top of all that, your cash flow grows every single year. How? You guys know rent increases 3 to 5% every single year. If you've ever gone ahead and done a lease renewal, you're going to say, yes, I want to renew my lease. And then you're usually disappointed when you realize that they haven't done anything, but there's still an increase in rent. That's just the market, though. That is just the market. So you might start off renting your property at $1,400 a month in 2026, but next year it's going to be $1,450. And every single year it's going to go up incrementally. And so your income literally starts growing over time. And one thing I want to mention to you guys here, just because it's top of my mind, I read about it today. One of the biggest plays, especially obviously long-term, right? You guys know that rentals is great because you have your cash flow, but it's nice to know that you're building equity, which is going to attach to your net worth, right? You know that over time, the property's value is going to increase and you're going to be able to extract money from it, whether it's selling it or doing a refinance. In 2020, houses were worth about $245,000 in some markets. And now they're about $423,000. The article that I read said that there's $11 billion in equity right now. People who just bought in 2020 before it boomed. So just 6 years later, 6 years, which honestly, if you think about it, 2020 was the pandemic. The pandemic to me feels like it was yesterday. I can't even realize that it's just been 6 years, right? Time really does fly. But if you think about it, in just that, what really feels like a short time span, imagine if you could have had $150,000 in equity in a property, $200,000 of equity in a property. And then you don't have to wait 20 years, but let's say now you're at year 6 and you're like, I kind of want to tap into that $180,000 of equity, that $200,000 of equity. And the beautiful thing about when you refinance and you extract equity out of a property, it's tax-free money. It's tax-free. So this is the last part of the strategy that I want to go over with you guys. So remember, if you buy with an asset-based lender, you use your Turnus, your Longhorn, whoever you want to use. Then you're going to let you renovate with their money. They're going to give you the funds to do so. Then you rent out your property so you can collect monthly cash flow. And because you now renovated the property, what happens when you renovate a property? The value of that property increases, right? It's worth significantly more now that it looks nicer, that people would be willing to buy it at a certain price. So once you've renovated the property, you do the refinance. A refinance is now you're going to get a new loan based off the property's current value. And the beautiful thing about these loans is that these are also asset-based lenders. And so you get these loans not based off your income, your credit. You get these loans based off the property's value and whether the property generates enough income every single month to pay itself. So basically, does your property break even every single month? Which should be, I always said that that's the bare minimum of a rental, but your rental should be generating money every single month, right? So you're not going to have an issue with, oh, does my property generate enough money? Your property should be generating enough money every single month to pay the mortgage and to pay you. So if you're in that position, you're going to be fine for your refinance. Now, when you go ahead and you refinance, based off of the property's new value, those lenders are going to give you 75% of the property's new value, that after repair value that we talked about earlier. Now, if you remembered, the asset-based lender that gave you the money to buy and to renovate the property, they gave you 70% of the after repair value. They gave you 70%. So you owe 70% of the after repair value to that asset-based lender. And now this new lender, when you went to refinance, is giving you 75%. So you have a higher loan amount right here. This higher loan amount is going to pay back what you owe the asset-based lender for the money towards buying the property and for the money towards renovating it. And now you're left with a higher loan amount that, again, your tenant's rent is going to go ahead and cover that every single month and pay you. And there's always a little bit extra. There's that 5% left in that equation, and you get to keep yourself. That's what's called the cash out refinance. So I know the refinance is sometimes confusing to people, guys. So let me know if you guys have any questions about what I've gone through. Oh man, you guys have a lot of questions. All right, let me attack these while we're here. All right, Steve. So yes, with regards to the renovation, right? The renovation is in draws, and so when you go ahead and you start your project, let's say in order to start a project, it's going to cost you $5,000 because your contractor is going to go to work, and the first thing he's going to do, let's just say, is he's going to paint the outside of the house. And so to paint the outside of the house, he's like, hey, it's going to be $5,000. Okay, cool. He goes ahead, he paints the house. You dish out $5,000, you pay him, and then 2 to 3 days later, your lender reimburses you. Because yes, you have to show that the house has been painted. All right, you got to show proof of the work being completed. So you would need the 5K to start the project. Do you have a lender for like strip malls? Kurt, I do not. Michelle, yes, this works for short-term rentals as well. So you can buy a property that you're going to designate as an Airbnb. The only thing is, and I just want you to make sure of this, when you go to refinance, you're going to use what's called a DSCR lender, debt service coverage lender. And a lot of them, I would say probably about 70% do not do short-term rentals. There are a few, and I have one in my mind that I just can't. It's on the tip of my tongue, but I can't remember who it is. But I'm sure you can just look up specifically short-term rentals DSCR loans.
Can I actually chime in about the Airbnb as well?
Yep.
Yeah. So, also from a tax standpoint, we always like to kind of make sure that we don't pay taxes. Like a Airbnb, is like the meta when it comes to taxes because you have what you call active participation in real estate and also material participation. And material or passive participation is like long term, like a long term renter, really not actively working, we're just getting paid on a month to month standpoint. Where Verbos and Airbnbs, they actually, from a tax code standpoint, they're looked at as actually active participation because you have a person that's there for less than 7 days. You're hiring a cleaning company. Now, of course, you could have somebody else do it, but it's being actively managed. So since it's being actively managed, any losses that you have, so if you do that cost segregation study that we talked about, Miss Hamilton or others, if you have active losses, you're able to write those losses off not towards your business income with your properties, but also to your W-2 income if you're working, or to your pension if you have one, or your Social Security. It counts towards your active income. So from a tax standpoint, we always recommend, after you kind of get serious about real estate, just having one Airbnb because that loss that you have can actually decrease your active income tax liability.
Yeah, absolutely. That's a great point. Another strategy that I did when I was a lawyer at the time, I forgot what the exact tax rule is, but essentially is if you manage your own properties and you're considered a real estate professional, I think it was like 15 hours a month was the qualification. You would be considered active in real estate. And there were certain deductibles you could have based off of that. And at the time, I mean, I still to this day I manage my own properties, so it's pretty easy to show that, get some tax benefits from that aspect when I was still a lawyer. So you guys can look into that. It's like the real estate professional.
Yeah, it's real estate professional. And for clients as well, we recommend if you have a spouse that's in like a homemaker, or you retired your spouse, if he or she gets their MLS, as long as they're doing 750 hours a year, then
Hmm.
it counts as that, which is 62 weeks, 62 hours in a month, which is basically 15 a week. But yeah, but that could be property management. So like to your point, like if you have rental properties and your own property management company, which is also a tax deduction that we talk about, it's a way for you or your spouse to basically manage that property and then or other properties that allows us to also have that as we're active. And then again, all your losses from a real estate standpoint goes towards your active income. So you making all the money in DC as an attorney, it probably helped you dramatically with your taxes, I would imagine, Sydney.
Yeah, this the second year helped a lot. I mean, my first year I was a lawyer, I got hit pretty hard, and then my second year, which was my last year, ended up getting a refund check, which was insane. But it was because the nice thing with I think buying with asset-based lenders is that if you guys remember, right, the lenders are gonna give you 100% of the money to renovate, but you get to write off those renovation costs. And so, for example, last year I think we spent like call it $700,000 renovating properties. Now the bank gave us the money, but we were still able to write it off as yeah, we bought these properties for cheap, but we also spent a lot of money renovating them, even though it wasn't money out of our own pockets.
Wow. And so and you go back like the last year you been a attorney. I mean, I'm not trying to check your pockets, but like get approximately how much you making as a lawyer? Because I just want people to understand, like with real estate, if you use the tax code properly, like you can literally have the IRS help you fund your dreams. So like approximately how much was you making that last year as a lawyer?
So my salary was like 230.
So you made $230,000 and you got a refund.
Yeah, yeah.
That's
I refund for like 25 grand. Yeah, yeah, which was an insane because I think I was making 230, right? But really my taxes were like one after I paid my taxes, I was really only netting like 170, right? I was paying like 60, 70K a year the first year in taxes. And then my second year, because I had bought all these properties and I was writing off my renovation costs, I ended up getting a check back for 25K.
that's crazy. Yeah, that's
Yeah.
crazy.
So again, the power of real estate and really just like at this point, you're not only making money off the bank's money, but you're having tax advantages just because you're borrowing the bank's money, essentially. So there's nothing you have to actually do in order to get those benefits besides being active in the space. So Raina, US is this? Yeah, this is hard money, right? So hard money is asset-based lender. It's used interchangeably most times. As far as points, it really depends on the lender. I always tell people this: there's over thousands of lenders in the United States of America. I will speak on behalf of like the 10 that I really interact with, and I'll say that majority of them, their points are going to be anywhere from 2 to 3 points, and interest rate you're looking anywhere from 9 to 12% interest rate for that loan. So again, though, the reason why I tell you guys you have to renovate quickly is because these loans, yes, you have a higher interest rate, but the goal is to buy, renovate the property, rent it out, and as soon as you rent it out, you go ahead and you refinance. So you don't want to refinance 2, 3, 4 years down the road. You want to refinance 4, 5, 6 months down the road. It's a quick turnaround. But the larger your rehab, it's going to be impossible to do that 3, 4, 5 months later, right? If your rehab takes you 6 months, you can't refinance at month 4. Because in order to refinance, the property's value has to have increased, which means that your renovations must be complete. And so that's why I urge you guys, if you're doing renovations, let them be cosmetic, where it takes you 6 weeks, 2 months, at most 3 months to actually do a project. Yeah, MJ. So the lenders that I mentioned, they work in Texas as well. Or you can connect with me on Instagram. I'm Cindy West on Instagram _. So pretty easy to find me.
Yeah, my moderators, actually drop our IG in the chat if I have not done that already, and actually spam the chat with all her information.
No worries. So, Kenya, great question. In order to refinance, you have to have a good credit score, correct? No, you don't. So, a good credit score can help you, yes. But essentially, if you have equity in the property, you own it, further refinance, it's going to be based off the value of the property, the income, and how much she'll give you for the refinance. Your credit score plays a role in that. So, what happens is that the loan to value will start coming down if you have a terrible credit score. Like, let's say you have a 400 credit score, right? A lender might say, hey, look, we'll refinance, but we'll give you 60% LTV, right? Loan to value, essentially. So, the credit is definitely going to help as far as getting a higher loan to value. So sometimes, for instance, I will do a refinance at 80% loan to value. Like I want a bigger loan amount because I want to get more money out of my property. But in order to get an 80% loan to value, you got to have a 720 credit score, right? Now, if you don't have that, then you're at 75%. If you don't have that, you're at 70%. So that's why what I really teach people is buy at 70%. And if you don't have the credit score at the moment, the goal is that while you are buying the property and you're renovating it, you can be increasing your credit score, or you can just go ahead and sell the property when you're done flipping it. Like this is the same exact strategy. People, they use either to fix and flip or what I call this is fix to rent, right? So at the end of my renovations, I don't sell it, I keep it. People who are flipping houses, they're using the same exact lenders, the same exact process. And so I have students that are like, I got a 500 credit score. And they're like, I don't really want to do credit repair right now. I just want to buy a property this way, rehab it, and I want to sell it and make $50,000. Okay, cool. Right? Because I always tell people, you flip when you want to amplify your capital and you keep it as a rental when you have a long-term play. And you're in a position, obviously, to keep that property and so forth.
You guys remember though, Uncle Sam will get the knocking on your door. because of course, if you do a flip, it's typically short-term capital gains, and y'all know how I feel, So Cindy, you may or may not know, but I say never sell, never ever ever
Reverse
sell.
that.
Let's hold that thing. Let's not pay Uncle Sam because, like, if you do the numbers, like if you compare apples to apples, you're actually losing money. You're
Mhm.
losing money that 1 year, but then 5, 10 years from now, you're really losing money from an appreciation standpoint, a cash flow standpoint, and then all the tax deductions that you have to recapture. So again, the cost segregation study, some depreciation that you got to recapture if you even did it when you first bought the property. Like just financially speaking, it really kind of makes no sense. Now, of course, if you're in a bind, you have to, then that's different. You can always
Yeah.
tend to on exchange, but just comparing apples to apples, like flipping, it just doesn't make any financial sense. That's just me. That's just it's your favorite certified financial planner speaking. But what do I know? What do I know?
So, but I do agree. I do agree, especially guys. I'm gonna show you this, right? So you can see what refinance numbers can look like. So this is a deal, and actually, I'm gonna give you guys two examples because we just finished up one with my brother. But this is a deal that my student did, Mike. Right? He bought it, renovated it, lender giving the money to do so, increase the property's value. So I want to show you this because when I showed you the refinance, and I always give this example of if it was 100 grand, and so people are like, cool, 100 grand, and then you owe 70 grand, the lender's gonna give you 75,000, and you're like, I just made 5,000. It's not a big deal, but this is how it really looks like when you start doing bigger numbers, right? So once the property was renovated and it had increased in value and it was worth $220,000, he got a new loan for $165,000 and first paid off what he owed the asset-based lender, right? He owed them money for buying the property and for renovating it. And then he was left with $45,000 of equity that he was able to just take back, cash at closing, tax-free, and now he's walking away with 45 grand. And so, Mario said earlier, right? Sometimes you can go and flip a house for $45,000, yes, but you're going to pay 30% taxes on that. Now, imagine you would extract $45,000 out of a property and you don't have to pay taxes off of it. And the even better part is you still own the asset and the asset still pays you every single month. So that's really the power of it. I mean, my brother and I, we did a deal, I want to say earlier this year, where we bought a 10-unit building for $370,000. Renovations were about 250 grand. The lender gave us all the money to do the project. And then once it was renovated, it was worth about $1.2 million. And so when we went to refinance, we got a loan for about 770 grand. We owed about 620. We got money back at closing, 150 grand for 7 months of work. And we still own the property. And the property, it collects about 11,000, 12,000 in income every month. And it pays us about 4 grand a month, 5 grand a month.
Wait. Hold on, Cindy. Hold on. First off, amazing. Second off, where did you find an apartment building for $300,000 at?
Here in North Carolina. Yeah, yeah. So this is a great market. Like this is exactly why. Obviously, I was a lawyer in DC, and then I moved down here within a year. I was like, I got to be down there.
Is it any other I mean, because I know Charlotte is a hot market right now. I went to Charlotte 2 years ago for family union, and I saw like all the building. I was like, man, it's like a gold mine. So
Yeah.
any other markets you think that's growing that kind of has like the because I know Charlotte also has an affluent side where it's people with money as well, which is great. Like any other areas here in America that you think is like a Charlotte right now, or maybe 5 years before Charlotte where is where today, where a person can maybe tune into?
Yeah, so obviously, I think the Midwest is strong. Indiana in particular is where I like seeing people at. So Indiana has obviously Indianapolis, but you have smaller towns like Fort Wayne, Indiana, and you're gonna have a lot of job growth, economical growth, and people moving there. So Indiana, I like, obviously you have your Ohio's, I think, not your Ohio's, but Ohio, which there's some deals, but it is still fair. It's still becoming saturated as every day goes by. I would say I like South Carolina. South Carolina is pretty cheap. I think it's at least top 5 in states that people are moving to. So a lot of people are moving to South Carolina. You just have to be careful with property taxes there because they're not that friendly. But if you know how to maneuver with it, you'll be good to go. So South Carolina, you have Charleston, you have your Columbia, you have Greenville, a lot of booming markets there. And then if I had to add another one, Missouri is a good one. They're pretty cheap over there still. So biggest thing, guys, when I always look at what markets to invest in, I always go to a website called worldpopulationreview.com. And on that website, you can put in any city and it'll show you how the population is trending. Obviously, you want to invest in areas that not only are cheap, but areas that are growing in population. So once you can confirm, okay, it's growing in population, people are actually moving there, my next step is to look at what kind of job growth, economic growth the city is having. And you can literally just look at, I want to say it's usually called like community plan. Geez, I know it because here in Charlotte we have one, but essentially if you just look up the local city that you're looking to invest in, and if you type in like community plan or development plan, every city is usually guided by some form of plan that has the development that they intend to do over the next 10, 20 years. And so it might be a little bit boring, I'll tell you that right now, because they're always like 50 pages, but it'll tell you what the city is doing. It's going to tell you the investments they've already received. It'll tell you what jobs they intend to have, what factories they're going to be building. And so for me personally, when I started investing out of DC, I invested in a town called Hickory, North Carolina, about an hour and a half from Charlotte. Never had heard of it before, but my realtor put it on my radar. When I started looking into it, I saw that Microsoft had done a $1 billion investment into it. And I was like, little town, like with 30,000 people, why would Amazon be putting $1 billion into it? But then I saw that they were going to be putting data centers there. They had a huge university that was actually pretty good. They had a lot of people moving away from Charlotte and they were seeing the growth. And so that's just a quick way for you to educate yourself, really. I mean, if you think about it, 50 pages at the end of the day to get background information on a market that you're going to invest in and you're actually going to take out loans, I think, at the minimum, it is worth your time. But that will give you more information on a market than any Instagram reel will, right? Any shortcut answer. Because the best cities, I'll tell you right now, are not the major ones. They're not the popular ones. So for example, I live in Charlotte, but I buy some houses in Charlotte. Let me say that. Majority of my portfolio is not in Charlotte. It's about an hour away. And it's in towns and cities that if I told you the name, you would be like, well, where the heck is that? You never heard of them because they're not mainstream. But the ones that aren't mainstream that they're going to grow. The cities are going to be investing money. They have companies investing money in there. They see that new construction, your toll homes, your Ryan homes, they're buying land. And even though that's a big one, like I always tell people, look at where the builders are buying land because it's easy for you to see when homes are going up, right? When you see the 100 homes being built, you're like, "Oh, yeah, this area is booming." But what about 5 years ago when they just bought the land? That's really where you get ahead when you're able to see, oh, they just sold 100 acres? Why are you buying 100 acres in the middle of nowhere? What do you see? And obviously, those companies, those builders are putting way more time and money into researching than obviously, we would. So those are just things to know. I always like looking at, who's buying large tracts of land, especially the big builders. Because if they're buying large tracts of land in certain parts, it's usually for a reason.
And when you go back to the lenders, because I know sometimes lenders want to kind of see like your business plan.
And so with these like asset-based lenders, they don't so much care about your LLC or your plan, right? So they don't look at like I know people always ask me about like NASIC's code and Duns and Bradley, all these things. And guys, I've been doing this for 3 years. I don't have any of those, codes, and I'm not registered. I don't have business credit. So I say that all to say, right? Should I? Probably, but I say that to say that you don't need those things in order to look bankable in terms of your LLC to a lender. All they're going to care about is the value of the property itself. And so to what Mario is saying, right, which is chat ARV, that is a tool that you can utilize where you can essentially quickly see the value of a property and then determine, am I actually buying it at the 70% rule? So it's a nice AI tool. You put in a property address and it'll say, okay, we're pulling data from Zillow. We're looking at what has sold over the last 6, 9, 12 months, properties that are similar to the one you're looking to buy. And here's what we think the after repair value is going to be. And that way you can get that number fairly quickly. And that's the same number that your lender's going to want, right? I always tell you, like, the deal always hinges on that one number for the most part.
Before we got to here, Cindy, you have to talk about your community. You have to talk about your mentorship. I mean, not a lot of people, I don't know nobody actually who bought 80 houses in 3 years with no money out their pocket. I mean, so you're like a dinosaur. You're an anomaly. So can you tell everybody about your community, how they can get in touch with you, how you've been helping your students? I know you showed the example of how your student, about the complex. So can you talk in general about like your community and how people can get in touch with you from a school part, but then also if they want you to coach them as they go through their real estate journey?
Yeah, absolutely. So if you want to go out and do this and you don't want to wait 2, 3, 4 more years of saying you're going to do this and you're like, I want to actually get into rentals. And what my community really does is we structure everything. We give you literally the exact same systems that I've used so that you can go out and buy your first property within 90 days. So most people are going out and they're buying their first deal within 30 to 45 days. Then they're going under contract and we're teaching them step by step how to find the deals, We teach you guys how to fund them. So we actually have a lender in-house. So I gave you guys 2 lenders that I've used, but we have our own lending company as well. So you don't have to worry about, am I going to get approved? Am I not? We literally cover the funding for you if you don't have money for closing costs. We also have additional gap funding that we can go ahead and get you guys secured. So you're always in a position to financially be able to buy the property. So we walk you through buying them. Obviously, walk you through how to renovate them. On our team is also my brother, who's a general contractor. We own a construction company. So again, we're giving you the same exact systems that we've used to not only renovate a few properties, but how we actually manage contractors. And obviously on the rent side, we self-manage as well. So I think we're really one of few that my coaching community really reflects the entire process, but it's a process that I literally still do to this day, right? So I buy, we're still renovating every day. We're renting them out directly. And so we have a lot of insight to then pass on to you guys so you can be successful. And so if you want to be in a room with people that are actually buying deals on a monthly basis, so most of them are buying 4 units. We had one student that bought 4 houses last week. We have another one closing on one tomorrow. Then that's going to be the room for you where you're going to have that support and you're actually going to have the real systems to go out and do it.
Amazing. So what's the goal? So I know you have 80 properties now, but like what's the goal? 1,000, 2,000?
I used to always say 500. I think it's like 500. Yeah.
500. And one more thing, because like a mindset standpoint, like can you like tell us like what was that aha moment for you where your mindset shifted? Like, okay, I can do this. I can do this with no money out my pocket. I'm going to start the journey, and I go from like I can do it, then I am going to do it right now. Like, can you talk about that mindset shift?
Yeah, I think for me, it was really just being a lawyer. And I'll never forget, I became a lawyer in October of 2022, and I worked Christmas Day. And I remember just thinking at that point, I have 2 options. I can either stay in the same position and complain about it, or I can actually do something about it. And the reality is that you have to fear more being in the same position you're currently in than what the unknown is. And trust me, I was working on Christmas Day. I was 27 years old. I was a woman. I had never been a contractor. I don't know anything about renovations, right? I hadn't been to Hickory, North Carolina. I didn't even know about Hickory, North Carolina, but I was like, I need to take this shot because if not, I'm going to be exactly where people around me are at. And I don't want to be there. I don't want to be working for the next 30 years. I don't want to keep waking up Monday through Friday at 9 a.m. and Sunday nights dreading my Mondays. And I think there really has to be a point where you make that decision of, I don't want this. This is worse than me risking something and possibly failing. Like that was the reality, right? Because I was like, everybody, you're gonna be afraid for your first deal. You're gonna be wondering, like, is this gonna work out? Am I gonna lose money? I don't know. This is scary. Is this contractor gonna run off with my money? There are risks involved, but there's a point where you realize that, you know what, I'm willing to take that risk because if I know that the upside is me learning the strategy, scaling a portfolio, being able to quit my job in 2 years, being able to become a millionaire, then let me risk it. Because the alternative to that is working this job that I hate and everybody around me doing the same exact thing, working a job that they hate.
Wow, that was powerful right there, Sydney. That was a tearjerker.
Like you gotta overcome that fear. And I always tell people this: for the most of us, information is no longer the issue. I'm sure you guys know exactly how you can go out, create generational wealth. You can go out and have financial freedom. I just happen to give you guys one more tool, but you know what you need to do. At this point, it's just you gotta go and execute on it.
Very true. Well, there's nothing else to be said. So thank you so much. My mod, spam the chat with Sydney's information again. You guys, please tap in, join her, at least join her. That's the least you can do is join her school community. But I would say you need to tap her in from mentorship standpoint. As you guys know, I'm blessed to know a lot of people. We're in the same mentorship group. So I know she talks the talk, but she also walks the walk. So thank you so much. Before we get out of here, though, I always like to lead us out in prayer. So we can all close our eyes and bow our heads. Dear Lord, thank you for your love. Thank you for your blessings. Thank you for being our lives. Thank you for allowing us to be healthy. May you continue to bless Sydney. May you bless her on her path. May you bless her students. May you bless her community. And may you bless her so she can continue to help people have generational wealth through real estate. In Jesus' name we pray. Thank you for all your love and blessings you bestow upon us. Amen. Well, I wish I had some church in here after that motivational speaking this game, man. I got a couple tears dropping, Sydney. Man.
You killing me. You killing me.
Awesome. Well, you guys be blessed again tonight at 7. My mind's put in the chat. I'm going to do a webinar about the recent change that President Trump did and how that's going to affect real estate and us having passive income. So I'll talk about that more in detail. But you guys, please tap in with Sydney. And again, Sydney, thank you for your time. We greatly, greatly appreciate it.
Thank you guys for having me. Appreciate it.
Cool. All right. Y'all be blessed. Peace.